four broad points that Nilesh highlighted: the real estate theme, state-owned banks, broadcasting, and overall, the political economy factor. How do you read the political economy, and also add any sectoral perspective that you might have at this stage?
Okay, let me first give you my market perspective, because I haven't really spoken about that yet. And so first of all, yes, there has been this huge run-up, which we spoke about in the beginning, that it's been a very good Samvat. But if you look at it historically, there was room to make this big move. If you look at each decade's returns, if you look at from the beginning of the Sensex from 1980 onwards, the first decade we compounded 21%, then 14%, then 17%, and 2010 to 2020 you were only at 8.5% or so. So that is why if you see going back from 2020 for 5 years, most equity mutual funds did not even meet savings bank returns. For 10 years, they did not beat fixed deposit returns. So that's where you were. So that is why even after this run-up, if you look at on a 12-year basis, you compounded only 10.5%. So you're still not come back to the trend line, let alone be way above trend line. So that is the source of comfort, if you can so say. So that is why if there is a correction which we are, or sideways movement, it is probably not cause for alarm. And this might also test out all the new investors that you spoke about in the beginning, that they had come in. And so this is like they saw only one side of the market. So this is a testing time maybe for them if the market corrects for a while. But otherwise, as I said, the risks don't appear very high, simply on that the returns are not way above trend. And normally big crashes or big bear markets come when the markets are way above trend. That is one part of it. Of course, last year, we follow a very diversified strategy, for starters, and that has given us not just a very substantial alpha, but also very, very good risk-adjusted returns. So, so risk is one part which every investor should always be cognizant of, that what is the system you are following to manage your risk. And in terms of sector themes, some sector themes which we have liked for a while still continue. IT services, for instance, which we identified about, more or less the time we started our PMS a year and a half ago. So at that time, the FMCGs were the flavor of the month, and I said that FMCGs, yes, they have good cash flows, good all of that, but IT services also have great cash flows, good margins, predictable returns, and they are a dollar hedge. And in very uncertain COVID times, that was one business where the demand was relatively more certain. So they have done very well. That theme still continues. I think IT and other tech still remains our number one bet sector-wise, even though, when I say number one, it still doesn't mean that we have 25% of the fund in that. So that's not what I mean. Selectively, chemicals still continue, cement and metals, but of course, with some caution that you have to watch out. Metals have been huge winners for us, but we have trimmed somewhat. In terms of what is changing, in my view, from what has been my view earlier, is financials. I am always extremely cautious on leverage plays, and particularly banks and lenders, because it's been proved right. 2020, I think Nifty Bank was the only sectoral index that was actually down for the year, and this year also the Nifty Bank has underperformed the NSE 500, etc., all the indices. But now that might change. I'm not saying that's going to be the best performing sector, but I think there are somewhat better times ahead for that sector. And also, as rates creep up, typically for lenders, that's a good thing, because your assets get repriced faster than the liabilities. So some amount of cleanup has happened. So that is like not contrarian from the market point of view, but contrarian from my usual point of view. That's different sector from what I have liked in the past, but you have to be flexible. That's the whole thing. You can't be married to a philosophy, which is why, you can't say that you'll always buy only great companies with great cash flows, which is why we got the metal cycle very well from almost a year ago. and that made us a lot of money. So in the market, the key is to be flexible, which is why we have the hare as our mascot. That you run fast, but you can change direction, and you want to emulate the hare in that it has 360-degree vision. So that's what you want to do. You want to be alert and alive to the changes, because
Sure.
last year and a half things have changed very fast at various times. So
Absolutely.
so be diversified, be cognizant of risks, but I don't think there are like a major crash ahead. That's
Okay.